Good morning, everybody. Today we're going to continue on our conversation to the one we had the other day, which was talking about the main problem underlying our economic system, which is our monetary policy driven by the central banks. As we know, prices are rising at a rate far greater than consumer wages are rising. Therefore, the gap is ever increasing. That is unsustainable because it means more levels of debt to bridge the gap between consumer wages and consumer prices. And it also means high levels of inflation where people's real purchasing power is falling and the overall standard of living is falling as well. So how do we get there? How does this happen? In our society, we all have central banks. Those central banks are in charge of the monetary policy. They create money if they want to, and they destroy money if they want to as well. How does this process happen? If the central banks wants to create more money, they will print that money out of thin air and they will loan it out to commercial banks. Those commercial banks will loan it out to businesses, private households for more economic activity, whether it's investments, private housing, private spending, you name it. Therefore, if there's more money in circulation, that increase in the money supply is an increase in the law of demand, where there's more demand in the economy from those dollars circulating. Therefore, prices are pushed up. Now, on the opposite end of that, we have money being the money supply being reduced, which is when a central bank increase the interest rate. Therefore, the interest on things you own, like houses, cars, investments, the price you're paying to borrow that money through interest is greater. So you're now paying a higher amount of interest to the bank. Therefore, there's less money in circulation in the economy. Ideally, prices like stabilize or go down, but you get the idea. Now, I've kind of given you a bit of an intro to how money is created, money is destroyed or reduced in the economy, how those lead to inflation and maybe deflation or like stagnation, I suppose you might say. But we need to talk about the fundamental issue of inflation, which is, again, consumer prices rising at a rate greater than consumer wages. Most economists, I think, would describe this as the money supply exceeding economic growth, right? So if you're producing goods and services at a rate of, say, 2 or 3% a year, GDP, but your money supply is at like 10%, then there is clearly a massive gap between how much you're producing and how much you can actually consume. And the demand is outstripping the supply of goods and services, right? That creates inflation. The economic growth is not keeping up with the money supply inflation. I hope I'm explaining that well enough. I know there are people out there way smarter than me that can explain this better, but I hope that's giving you a rough idea of how inflation is occurring. This is clearly a problem because it's kind of what we have at the moment where we're printing money. The demand is outpacing supply, therefore the price of products is getting pushed up. Now that we've talked about inflation, the money supply increasing greater than the rate of goods and services provided, demand outstripping supply, prices rise. We'll leave the video there for now, and then the next video we'll talk about some possible solutions from an Austrian classical and a monetaristic perspective on how these problems can kind of be solved and demand can be put to an end. See you in the next video. Cheers, guys.